levy became an intricate part of our savings as a nation. The asset class real estate was effectively born, and it essentially became an institutional asset class for the first decade. In the mid-90s, retail superannuation really started to take off, and the asset class then needed to become front and centre for our retail investors. Real Estate Investment Trust was then born because we wanted to give retail investors access to what is very, very expensive, large capital asset class, very difficult to get invested in for a small amount, but also in a listed environment. So a real estate investment trust effectively houses large, predominantly diversified commercial real estate assets into what is quite a tax-effective, unitised trust structure that allows investors to be able to buy and sell units within that particular trust structure in a very efficient way on a listed exchange such as the ASX. Predominantly, a REIT houses a particular sector specialisation, such as industrial or office, or it might be at retail. Recently, we've seen such as social infrastructure become a component or an additional sector. Quite often, these are pooled investments, so many investments in one vehicle. So investors get the benefit of the diversification in the one sector, or a diversified set of sectors that might be across all those just mentioned. So it can be a very diversified vehicle, or it can be a very single sector vehicle, but again it gives access to many assets in one pooled investment vehicle. So REITs give you access to a very securitized long-term income stream. The very nature of a unitised trust structure is to provide non-discretionary, that is, all the income predominantly gets redistributed to the investor, up to about 90%, to stay classified as a unitised trust structure. The unitised trust structure does not pay tax itself, unlike a company. The income is fully distributed to the end investor, and the end investor pays that tax or has that tax impost. Income plays a really big part in why we might invest in a real estate investment trust. Predominantly the REIT manager, such as Charter Hall, we manage on behalf of the investor. We collect rent from these commercial premises that are generally on very long-term leases to strong tenants, and that is simply redistributed to the investor. That's the nature of a unitised trust structure. The second part I would say also is that it plays a very important part in a strong asset allocation framework, where investors are looking for uncorrelated returns to equities or that might perform with a higher return of income, and particularly when we see interest rates at such low levels today. Yeah, so in most investments there's always risks associated with any investment. But what I would look for, just some steps in looking through a real estate investment trust. Firstly, I'd look at the manager selection. I'd look at the quality of the manager, I'd look at the experience of the manager. Secondly, within the vehicle itself, I'd look at what the vacancies are within the particular sector. I'd look at the quality of the tenants. It's really important to have high quality tenants, because even though they may be on extended leases, it's only the ability to be able to pay that income that really drives the growth and your distribution. So again, I'd very much focus on tenancy quality. As for the structure itself, well, we would imply that gearing should be very modest. Average or modest gearing of around 20 to 30% would be consistent with what the industry sees as being modest in terms of gearing. I'd also be very wary of things like interest rates and inflation, and that can be the greater enemy to these types of structures. So I'd look through to see what your manager's interest rate hedge policy is, and I'd also look to see whether there's any escalators within your lease expiry or lease structures that may be able to buffer any of those inflationary pressures that are brought on by economic growth. So in Australian commercial real estate, we generally sign up commercial terms based on either an inflation or a fixed rate rental increase over time. So when I mention the term escalator, what I'm talking about there is the increase that the tenant pays on an annual basis of his rent based on either those inflationary measure or as a measure of fixed rate. As per any investment manager, there are costs associated with running a particular unitised trust. So there would be a specific running cost, which we call a trust expense. And secondly, the manager themselves needs to be remunerated for the work they do. The work that a typical investment manager does, or a REIT manager, would be to acquire the assets, to dispose of the assets, and to manage those assets. That's managing those tenants. Obviously the work that goes into the leases, as well as the administration of the fund. So you would typically expect a management expense recovery, as well as a trust recovery or trust recovery cost in any investment into a REIT. Yeah, so a real estate investment trust on the listed market, whilst it has what we call a net asset value, it can be priced very differently according to what its future cash flows are. Very similar to the particular earnings structure of an equity or a stock or a company. So it can be priced very differently based on future earnings, on PE ratios, things that are very different to what its actual NAV or net asset values, the value of, we look all the assets within the fund, and that can be trading at what we call a discount or a premium to that net asset value.